Good morning, ladies and gentlemen. This is part two of the analytics on the market, the technical analysis as well as the fundamental analysis, some behavioral stuff put in, as I talked about in the first video cast. Let me continue here with the S&P 500 that a lot of you are familiar with. So here we have the highs on the market going back to May of last year, um, and just to give you a reference point, and this is where we are right now. So let's get straight into the explanation. And for now, I've hidden all the trend lines and everything that I draw on these charts, and I'm going to put them back on in the next couple of minutes. So here's your clean, simple, plain vanilla chart of the S&P 500 with a bunch of things here, such as the Bollinger Band, the 50-day moving average, the 34-day moving average, the highways that the market normally travels in, and when we deviate too much from that, as I've talked about extensively before, you get you deviate way too off the highway. It's known as a standard deviation. Whether you deviate higher away from the highways or lower, in this case lower, similar to what happened back during the flash crash of August 24th, well, you have a reversion to the mean. So what we really see happening right now in the form of the market just thrusting higher every single day, um, specifically in certain sectors, but across the board, strong breadth, powerful moves, very slight pullbacks intraday, which are bought up, massive short squeeze, all are manifestations of a very simple technical rule, and that is mean reversion. Okay, mean reversion simply means you go back to the mean. You don't want to know what mean reversion is. You go ahead and look at the definition of that on Investopedia. So you revert back to the mean. In other words, in simple English, as I explained to a kindergartner or some kid, as I explain all this economics to my son and for the investment club and stuff like that, you get back on the highway. Now the highways are sloping downwards. You can clearly see that, right? Just the way they were sloping downwards here. Very clear to see. Look at this. 50-day sloping down, 34-day sloping down. Exact pattern symmetry to what we're seeing here. Now, trying to get that drawing tool and see if I can get it. Bear with me. Well, forget it for now. Just let me show you off this thing. So you have this very similar to the flash crash reversal here. This is more powerful because this is a clear inverted hammer. This wasn't. If you think about it, this was an inverted hammer, but not as powerful as this one. Then you got a retest here on September 29th. You get a retest here with another inverted hammer here in the 1800s. And this was back last Thursday. Okay, that was last Thursday. Remember I said, don't short Valentine's and President's Day weekend. So, and that's exactly what happened. So the bottom line is that you have this double bottom in place, and let's see in simplistic terms what's going on. Here you have the 34-day moving average. We're crossed over that. We are reaching overbought levels, so strong markets can stay overbought. We saw that before here. Look what happened. We kept on moving higher. We crossed over the 34. We had a slight pullback. You can see that inside candle, inside day, and then a follow through continues with 2 days of pullbacks, creating a consolidation flag, moving higher, 2 days of pullback, consolidation flag, and continue higher. I'm not saying that's going to happen. I have no idea if that's going to happen. All I'm basically saying is that I'm looking at the pattern symmetry here. Downward sloping moving averages, yet the market thrusts higher. This is a similar type of thrust that we saw back on September 29th. Look at the similarity. Look at these candles. Massive short covering. Companies. Well, here's another very important thing here. Earnings season is going to end. I mean, earnings reporting is going to end in a week or so, right? Week, 10 days, somewhere around it, 2 weeks from now. Well, guess what? The stock buybacks start in full blast. company corporate stock buybacks. We've seen a bunch of them being announced and being put into effect. Those are very powerful catalysts for the market. Don't stand in front of massive stock buybacks. They're not going to tell you, "Oh, I'm buying stock back on Monday morning at 9 a.m." But they issue the press releases saying they're going to buy back, and companies are allowed to buy back stock after the quiet period is over, after earnings are released. They can do it before earnings release, just so you know that. Okay, so figure out when they're releasing the earnings. After that, they're free to go. And during the communique and the press releases, during the conference calls, they let you know that they will be initiating stock buybacks. That's it. So stock buybacks are a very powerful force that drives markets higher. Given the pullback in the market, given a 3,000 point drop on the Dow Jones from over the last what is it, since from the 18,000 down to the 15,000s and now climbing back up, you can rest assured that companies will be buying back their stock to a certain degree. So here we are, technical stuff. Over the 34, minor pullback. Over the 34, I don't know if we might get a minor pullback today. We might get it Monday. I don't know. I can't time that. But and then move forward to engage the 50-day moving average. 50-day moving average is here at 1960, not 1955. I correct myself. 1960. That's where the 50-day engages. The market engages the 50-day moving average, downward sloping. Now we have a resistance here, which is obvious, where we failed. You can see that. And that was at 1947. So one way or the other, we're going into the 1940s, in my opinion, which also happens to kiss the upper Bollinger, this blue line right here, right? And Bollinger, and these are the acceleration bands here you're looking at, the gray ones. Let's see which one's the acceleration bands, which one the Bollinger. 1 second. Edit studies. You're going to look at the colors because you can't tell. So Bollingers are the blue ones. Good. So I was right. So these are the Bollingers, and these gray ones are the acceleration bands. Both are basically trading bands, envelope, where markets can trade in. So upper end of the Bollinger right here is 1948 or so. So at that point, believe it or not, that's also the point where we got rejected really hard, similar to the rejection here that happened. Okay. And that was at and that's around 1949. So around 1950, expect a pullback. Just the way here, look, it hit that there, and there was this consolidation pullback for 2 days. So once we hit 1950 or so, give or take, right? 1950 or 1948, expect a 1-2 day quick pullback. I believe that comes in the early part of next week. Then comes the rush for the window dressing that leads into the end of the month, because they are, in my opinion, high probability and going to end the month on a strong note. Okay, period. They're going to end the month on a strong note. They're not going to give away this move in the markets and just give everything away on the last couple of days of February. That's my opinion. And you know what window dressing is all about. I've talked about it extensively. It simply means where portfolio managers are rushing in to spruce up their portfolios, buy the high beta names to show to show alpha or outperformance on their portfolios, which have been underperforming the market for a while now. So saying all that, this is the level that you're going to see some resistance. And once you cross over 1960, you go up for a day or two, just looking at the exact pattern symmetry of what happened in September. Then you get a quick little consolidation for 2 days, and then you move forward. I still believe that the upper end of this acceleration band, or the 1975 level, gets engaged at one point or another by the end of February. Okay, so that's another 50 or so S&P points. Do the math. That's roughly another 300 or so plus Dow points. That's it. In the meantime, look at the daily. The daily is certainly in overbought territory. There's no question about it. Okay. So the $1 billion question is: are we going to basically hit the top here, give or take a few more points, and then just collapse to reset? Just like that, as I explained in the first video cast? Or are we going to continue with minor pullbacks and in overbought territory all the way up towards the 1975 level? I don't know yet. We'll see. In the meantime, the McClellan oscillator, which was deeply oversold, and I did show that positive divergence many times, and the few of you who actually noticed it are benefiting from that. This was the positive divergence that I showed from this bottom, 1800 bottom at the end of January, to the recent last Thursday's bottom. I showed the positive divergence here, just the way there was a positive divergence here. Bingo. It's not magic. It's just observation and acting on it. Not just observation, but you have to act on it, right? Because without action, the results are not going to come. And the famous last words: the pain of sacrifice is far less than the pain of regret. And right now, the majority are suffering the pain of regret. It's the same old story over and over again. I have nothing to say. Okay. So here was the positive divergences which played out on this double bottom, right? And on this double bottom. And there was here another double bottom. And here was the positive divergence. Learn. It's not like this is the first time it's going to happen, but at least next time, as many have done repeatedly, because habits are very difficult to shake off, done stupid things by not buying lows, not buying into as the market makes new highs, short-term highs or whatever the case may be, or not realizing when there's the free falls and always looking for a bottom till the bottom comes and goes and they miss it. Well, stop this crazy stuff. Try to do some small stuff that incrementally makes you a better trader and a better investor. That's the way I look at it. That's the motto that I follow. So here we have another bottleneck. You can see that right there on the Davos box. And bottleneck simply suggests that there's going to be an outsized move. Now, we already had a big outsized move. It doesn't mean that we can fall to 1900, which is roughly about 1900 is only roughly about 180 points or so on the Dow. It's not the end of the world. We can come to the lower end of the bottleneck right there and bounce from there. It resets. It does a moderate reset of the indicators. We are getting overbought on the McClellan oscillator. The McClellan oscillator actually doesn't get fully overbought till about 303. You can see that there. And you can see here that the McClellan oscillator was actually going down as the market was going higher. So that was kind of a negative divergence. But if you played it right based on the market, then you'd have made a lot of money on this side while the McClellan oscillator, and then came the pullback, obviously. Inevitable pullback, and the McClellan oscillator at that point bottomed. So the McClellan oscillator is not always, other than extreme conditions where it gets deep oversold in the minus 300 region, right? Those are excellent buy points. But on the upside, keep in mind that once you cross over the 300 mark, you need to pause a little bit. You got to take your profits. You got to take your profits anyways, partial profits along the way. And because right after that, you got this consolidation, right there, right? This consolidation. 2 days of bang, bang, down 200. Everyone's like, excuse my French, shit scared again. So I don't know whether or not the intermediate bull trend is going to resolve. The 1950 level is going to be a key mark. I've said it, and I'm saying it again. Right there. Actually, it's right there in this zone, right? Because that was the point of maximum rejection. Let's see what happens there. Now, the other key thing that I want to mention about this business is if you sit around and overanalyze, you're going to miss out. It's happened to me, and it's happened to all of you, and for some of you, it's happening all the time, okay? You keep on sitting and watching and not doing anything, not even buying one share, like I like to say, okay? And I'm not kidding around. Buy one share. Then you're not going to get anywhere. And it doesn't matter whether you get hit in one trade or not. Have cash on the side so you can act on the next one. And there's no, I put down multiple suggestions. These are all suggestions. These are not forced recommendations. These are all suggestions. So if you pick and choose one that doesn't work, then don't come, crying like a little baby. The bottom line is buy multiple suggestions, smaller lots, and go with it. That's just the way it is. Thank you for listening. Thank you for the support. Send the referrals over. I'll be holding weekend sessions, advanced coaching sessions. Sign up for them. They make a huge difference. Thank you for listening.